Did you see what just happened? If you blinked, you missed it. If you were listening to the mainstream financial news, they didn't even mention it. But for those of us watching the order flow, something terrifying just occurred in the silver market. Last week, we saw a massive sell order hit the COMEX. It was a classic slam. In any other year, 2015, 2020, even 2024, this would have triggered a cascade. Stops would have been triggered. Panic would have set in. The price would have bled out for weeks. But this time, the price didn't bleed. It bounced. Within hours, that entire dip was bought up. Not by thousands of retail traders clicking buy on their phones, but by one massive, relentless vacuum cleaner. This isn't normal market behavior. This is a glitch in the matrix. It tells us that there is a ghost in the machine. A buyer who doesn't care about the chart patterns, doesn't care about the Fed, doesn't care about the technicals. A buyer who is simply terrified of running out of metal. We are witnessing a historic changing of the guard. For 50 years, the price of silver has been set by paper speculators, men in suits in Chicago and London trading digital contracts. They trade on sentiment. If they feel good, they buy. If they feel scared, they sell. But the entity that bought that dip last week, that wasn't a speculator. That was a survivor. We have moved from an investment phase to a survival phase. Think about the difference. An investor buys silver because they want to make a 20% profit. If the price drops, they get scared and sell. But an industrial giant, a solar manufacturer, a defense contractor, an AI chip maker, buys silver because without it, their factory stops. Their revenue hits zero. They are not price sensitive, they are supply sensitive. When a market shifts from speculators to industrial survivors, the rules of gravity change. Dips don't last because the floor is made of concrete. Every time the paper market tries to push the price down, the physical market says, "Thank you for the discount," and swallows the inventory. This is happening at the worst possible time for the short sellers. You have to look at the context. For half a century, silver has been the contained commodity. While copper, gold, and oil have all made massive new highs over the decades, silver has been kept in a psychological cage. Analysts call this compression. Imagine holding a beach ball underwater. It takes constant, relentless pressure to keep it submerged. The deeper you push it, the more energy it stores. For 50 years, the paper market has held that ball down. But the Super V recovery we just witnessed, that was the hand slipping. The pressure required to keep this market contained is becoming mathematically impossible to sustain. But to understand why the hand is slipping right now, and why the explosion is going to be far bigger than anyone anticipates, we have to look at the new oxygen of the economy, that is draining the vaults faster than the miners can dig. To understand why this move is different, you have to understand the physics of the paper ceiling. For 50 years, silver has been the most manipulated asset on the planet. I don't say that as a conspiracy theorist. I say it as a market analyst observing the data. While copper, gold, and the S&P 500 have made massive new highs over the decades, silver has been kept in a psychological cage. Analysts call this compression. I call it the beach ball effect. Imagine you're holding a fully inflated beach ball underwater. The water pressure represents the billions of dollars in paper derivatives, the naked shorts, that banks use to cap the price. The air inside the ball is the fundamental demand. For decades, the short sellers had strong hands. They could push that ball down to $15, $20, even $30 without breaking a sweat. But the physics of compression are undeniable. The deeper you push it, the more energy it stores. If you lose your grip for even a second, that ball doesn't just float to the surface. It launches into the stratosphere. What we saw last Tuesday, that 4-hour Super V recovery, that was the hand slipping. The paper market is losing its grip because the volume of air inside the ball has just doubled. And the reason isn't inflation or retail stacking. It is a technological shift that Wall Street completely missed. For years, the biggest argument against silver was something called thrifting. Goldman Sachs and JP Morgan have told you the same story 1,000 times. If the price of silver goes up, industrial companies will just use less of it. They will engineer it out. Demand will crash. It sounds logical, right? If beef gets expensive, you buy chicken. But here's the problem. You can't build a solar panel out of chicken. They are lying to you. Or worse, they are using data from 2020. Because in 2026, the solar industry isn't using less silver. They are using more. Let me introduce you to the acronym that destroys the bear case, TOPCon. Up until last year, most solar panels used PERC technology. It was efficient enough, and it used about 10 milligrams of silver per watt. Manufacturers were indeed getting good at using less silver, but PERC hit a ceiling. It couldn't get any more efficient. To hit the new energy targets, to get that 26% efficiency rating that the market demands, the industry had to switch to TOPCon, tunnel oxide passivated contact cells. Here is the dirty little secret of TOPCon. It is a silver vampire. It requires pure silver paste on both sides of the cell. It uses approximately 13 milligrams per watt. That is a 30% increase in silver consumption per panel. We are not thrifting, we are gorging. In 2025 alone, the solar industry consumed over 200 million ounces. That is nearly 25% of the entire annual mining supply. And that was before the full transition to TOPCon, which is happening right now. This brings us to the most dangerous economic concept for a short seller: inelasticity. Inelastic demand means the buyer must buy, regardless of the price. Think about oxygen. If the room is running out of air, do you negotiate the price of an oxygen tank? No. You pay whatever is asked. Silver is the oxygen of the AI economy. You hear about the AI boom every day. You hear about NVIDIA chips and data centers, but what they don't tell you is that AI is an energy glutton. A single new AI data center requires as much power as a small city. To generate that power, they are building massive solar farms. To move that power, they need high-voltage connectors. To manage the heat in those servers, they need thermal conductors. Silver is the most conductive metal on the periodic table. It is not optional, it is physics. A single 500 megawatt solar array built just to power one hyperscale data center requires roughly 300 metric tons of silver. That is 9.6 million ounces for one project. When Microsoft or Google builds a data center, they don't care if silver is $30 or $100. The silver cost is a rounding error in a $10 billion project. But if they don't have the silver, the project fails. They are not price sensitive, they are supply sensitive. And for the first time in history, the supply isn't there. So we have the demand side, a solar industry that is panic buying and an AI sector that is just waking up to its own thirst. But to understand why this is a crisis and not just a rally, you have to look at the supply side. We have been lying to ourselves for 5 years. Since 2021, the world has consumed more silver than it has produced, every single year. Look at this chart. In 2021, we had a deficit of 50 million ounces, manageable. In 2022, it jumped to 238 million. In 2023, 2024, and 2025, the deficits kept piling up. If you add it all up, we have burned through over 800 million ounces of above-ground stock in just half a decade. Where did that extra metal come from? It didn't come from mines. It came from the vaults in London and New York. It came from the seed corn. We haven't been mining enough silver to run the global economy. We have been cannibalizing our strategic reserves to keep the lights on. And 2 weeks ago, on January 1st, the country that controls the processing of that silver decided to lock the door. This is the news that the mainstream media is ignoring, but it is the single most important event in the precious metals market since 1980. Effective January 1st, 2026, China implemented strict export controls on silver. They have officially reclassified silver from a standard commodity to a strategic mineral, placing it in the same restricted category as rare earth elements. Why does this matter? Because while China mines only about 13% of the world's silver, they control nearly 60% of the processing capacity. Most of the silver mined in South America or Mexico ends up in China for refining. For 20 years, China was happy to sell that refined silver back to Apple, to Samsung, to Tesla. But now they are keeping it. They have limited exports to only 44 state-licensed companies. Think about the game theory here. China dominates the solar panel market. They dominate the EV market. They know they need billions of ounces of silver to maintain that dominance over the next decade. Why would they sell their strategic advantage to the West for paper dollars that are losing value? They wouldn't, and they aren't. This creates a terrifying math problem for the COMEX. When you run a deficit for 5 years, you drain your buffer. We track a metric called months of available supply. Historically, when this number drops below 4 months, price volatility explodes. Right now, if you look at the registered inventories at the COMEX, the silver that is actually available for delivery, we are effectively operating on fumes. We are below the red line. We are watching a wealth transfer in real time. The West has been selling its family silver to the East for pennies on the dollar, And by the time the regulators wake up and try to stop it, the vaults will be empty. This isn't a theory. We are seeing the inventory numbers at the LBMA drop to critical levels. The float, the amount of silver actually available for sale, is razor thin. And that brings us to the final trigger. The one thing that turns a shortage into a panic. The geopolitical wild card that just got played in the Middle East. We have talked about the physical shortage. That alone is enough to double the price. But we cannot ignore the monetary backdrop because this is the fuel on the fire. The original transcript mentioned elevated debt levels. That is the understatement of the century. In 2026, we are not just elevated, we are insolvent. Look at this. For the first time in American history, the U.S. government is spending more on interest payments for the national debt than it spends on the entire military. We are borrowing money just to pay the interest on the money we already borrowed. This is what economists call a debt death spiral, and it forces the Federal Reserve into a corner. They have two choices: let interest rates rise and bankrupt the U.S. government, print trillions of dollars to buy the bonds and suppress rates. They will choose option two. They always choose option two. This is yield curve control, even if they don't call it that. When the market realizes that the dollar must be debased to keep the government open, capital flees paper assets. It looks for a lifeboat. Gold is the first lifeboat. It's the battleship. But silver? Silver is the speedboat. Historically, when the monetary system breaks, silver doesn't just track gold, it outperforms it. This brings us to the slingshot effect. Right now, the gold to silver ratio is hovering around 85 to 1. That means it takes 85 ounces of silver to buy 1 ounce of gold. Geologically, the ratio in the ground is about 8 to 1. Historically, the monetary ratio is 15 to 1. Whenever this ratio gets stretched this wide during a crisis, it doesn't just correct slowly, it snaps back violently. In 2011, it dropped to 30. In 1980, it dropped to 17. If gold hits $3,000, which is conservative given the debt spiral, and the ratio snaps back to its historical average of 30, do the math. That is $100 silver. That is without even factoring in the solar shortage we just discussed. When you combine the industrial squeeze, TOPCon AI, with the monetary squeeze, debt inflation, you create a perfect storm that we have never seen before. Now, I know many of you are stackers. You want the metal in your hand. I agree. That is your insurance. But if you want wealth generation, you have to look at the mining companies. The transcript mentioned that mining equities offer leverage. Let me explain what that actually means in plain English. Let's say it costs a mining company $20 to pull an ounce of silver out of the ground. If silver is trading at $25, they make a $5 profit. But if silver moves up just 20% to $30, their profit doubles to $10. A 20% move in the metal murmurs a 100% move in profit. But here's the catch. The mining sector has been decimated. Investors have hated these stocks for a decade. They are trading at valuations we haven't seen since the Great Depression. Capital has been starved. No one has been building new mines. Remember the compression we talked about earlier? It applies to the stocks too. When the price of silver breaks $50 and holds, these companies are going to turn into cash printing machines. And because nobody owns them yet, the rush to get in will be chaotic. However, a warning. Not all miners are created equal. When the mania starts, a lot of garbage penny stocks will soar. Companies with no silver, just a plot of dirt and a good PowerPoint presentation. In this phase, you want producers. You want the guys who actually have the metal coming out of the ground today, because they are the ones who can sell to the Chinese and the solar companies now. The explorers? They might find silver in 10 years. That's too late. The squeeze is happening now, so strategy check. Physical metal for safety, to survive the currency collapse. Producing miners, for leverage, to profit from the mania. We have the industrial squeeze, we have the monetary debasement, we have the mining leverage. All the pieces are on the board. The only thing left to discuss is what happens when the public finally wakes up. So let's bring it all together. We have a beach ball market that has been held underwater for 50 years, building up explosive kinetic energy. We have a solar and AI industry that has suddenly become a vampire, sucking 30% more silver out of the vein with every new panel and data center. We have a sovereign debt crisis that forces the Federal Reserve to print the dollar into oblivion. And now we have the Great Wall of China locking the exit doors on 60% of the world's refined supply. This brings us to the final phase of the crisis. I call it the Unobtainium Phase. Most people are sitting on the sidelines waiting for silver to hit $50 before they buy. They are waiting for a confirmation signal from the chart, but they are missing the point. The crisis won't be signaled by a high price. It will be signaled by no price. The scariest day in this market won't be when silver drops 10%. It will be the day you call your bullion dealer ready to buy, and they don't give you a price at all. They will just say, "I'm sorry, we have no inventory, and we don't know when we're getting more." At that moment, the spot price on your screen could say $30, $50, or $100. It won't matter. Because price is irrelevant when availability is zero. We are already seeing the cracks. The premiums on American Eagles are widening again. Delivery times are stretching from days to weeks. The liquidity is drying up. The window is closing, not because of price, but because of physics. So what is the play? How do you position yourself when the paper market is burning down? Number one, stop looking at the spot price. The spot price is a distraction. It is a noise signal generated by high-frequency trading bots in Chicago that are trading air. It does not reflect reality. If you're waiting for the spot price to confirm your thesis, you will be too late. Watch the premiums and the inventory levels. That is the real price. Number two, secure your physical insurance first. Before you gamble on mining stocks, you need to own the asset that has no counterparty risk. We are in January 2026. The export bans are live. The deficit is mathematical fact. If you do not have your physical position established, the metal you can hold in your hand, you are gambling with time you do not have. Number three, then look for leverage. Once your insurance is set, look at the producing miners we discussed, the companies that have the metal today. When the panic hits, capital will flood into these stocks like water into a dry sponge. A 1% allocation of global capital into the mining sector would send these stocks to the moon. History is full of moments where wealth was transferred in the blink of an eye. It usually happens when the majority of people believe that tomorrow will look like yesterday. They believe the paper promises. They believe the official inflation numbers. They believe the system is solid, but the system is fragile, and right now it is running on empty fumes. We are witnessing the end of the paper era and the return to the hard asset era. When the music finally stops, and it is slowing down as we speak, you do not want to be the person holding a paper receipt for a chair that doesn't exist. You want to be the person sitting in the chair. Paper burns. Metal lasts. Make sure you are on the right side of that equation. If you want to navigate this transition without losing everything, you are in the right place. We don't just read the news here, we read the signal. If you want to be part of the few who understand what is coming while the rest of the world is distracted by the noise, then you know what to do. Join us, subscribe, and turn on notifications. Because the next time I make a video, the buy button might already be gone. I'll see you on the next one.